am Lyanna Jade Dahan, a grade 11 ABM student from Section Broca. Today, I will present to you the 5 major accounts in accounting. What is current assets and non-current assets? The current liabilities and non-current liabilities. What are account titles? What is chart of accounts? And an overview about balance sheet or statement of final positions and income statement or statement of comprehensive income. So what are the 5 major accounts? There are 5 types of major accounts: the asset, liabilities, owner's equity, income, and expenses. Asset and liabilities and the owner's equity are considered the elements that are directly related to measurement of financial condition in the statement of financial position, while income and expenses are elements directly related to measurement of performance in the statement of comprehensive income. Assets are the resources owned and controlled by a business or company that would give them or provide them future economic benefits. In layman's terms, assets are defined as things of value that are owned and used by the enterprise in its operation. Examples are cash, building, land, machinery, furniture, and fixtures, equipment, tools, and etc. It also includes inventories, prepaid expenses, and the debt collectible by the enterprises from a customer which term as receivable. As per Philippine accounting standards, assets are classified into 2, current assets and non-current assets. We will discuss this later. Second is liabilities. Liabilities are obligations of the business or company to its creditors arising from the past events which are to be settled in the future. Examples are debts and payment, obligations to creditors. Some specific examples of what a liabilities account might include are business loans, late utility bills, account overdrafts, unpaid bills, loans, or any other sum of money that you owe to someone. Owner's equity is the residual interest from the business. It can be derived by deducting liabilities from assets. Equity accounts shows the value left in a company's assets after it's conducted its total liabilities to represent the current worth of the company. It is expressed in the equation as assets less liabilities equals owner's equity or capital. Income or revenue accounts record the amount of money a company or business earns from selling something or rendering a service. Income or the profit a company retains after paying off all relevant expenses from the sales revenue earned. It is synonymous with net income, which is most often found at the end of the income statement. Service income, professional income, rental income, interest income, and miscellaneous income are some types of income or revenue accounts. Expense are the amount consumed by the business or company to operate. They are the results of attempting to generate revenues or additional income. These may include purchasing products or services to boost the productivity of its manufacturing or distribution operations. In simple terms, expenses means cost. It is the operational cost that is paid to earn business revenues. Refers to the outflow of cash in exchange for commodities or services. Cost can alternatively be expressed as the total of all activities that typically results in profit. Supply expense, rent expense, salaries expense, gas and oil are some examples of expenses. Let's proceed to current assets and non-current assets. Current assets are those assets that are related to their normal operating cycle. Operating cycle is the interval of time from the date of acquisition of merchandise inventory, sell the inventory to customers, and the ultimate collection of cash from the sale. Anything that is related to the normal operating cycle of a company or something that is just within one year, that's basically current assets. All the assets of a company that are expected to be conveniently sold, consumed, used or exhausted those standard business operations within 1 year. Examples are cash equivalents, petty cash fund, notes receivable accounts, accounts receivable, estimated and collectible accounts, advances to employees, inventories, prepaid expenses, and short-term investments. While non-current assets are assets and property that a company owns that can be quickly turned into cash within a year. They usually have a high value and benefit the businesses for long periods. Long-term assets is another name for non-current assets. Non-current assets are for long-term usage of the company and are expected to help generate income. Examples are land, building, equipment, furniture and fixtures, and accumulated depreciation. Next is current liabilities and non-current liabilities. Current liabilities is an obligation that is payable within 1 year. It is a financial obligations of the business which are expected to be settled in the normal course of the operating cycle. It is also called short-term liabilities. Examples are accounts payable, notes payable, accrued expenses, and unearned income. Non-current liabilities is a financial obligation of an enterprise on a company's balance sheet that are not expected to be paid off within a year is referred to non-current liabilities. Unlike short-term liabilities, which are due within a year, non-current are due over a longer period of time. Examples are notes payable, mortgage payable, term loans, and deferred tax liabilities. What are account titles? In accounting, account titles are the names given to the various categories used to keep track of business finances. Specific name given to an account in an accounting system is known as the account title. An account title is essential when the accounting staff needs to identify a particular account. What is a chart of accounts? A chart of accounts is a list of all the accounts you must use to record financial transactions in a general ledger. It helps to keep track of where money comes from and goes. A chart of accounts is integral to your bookkeeping, accounting, and financial reporting. It is arranged from assets, liabilities, owner's equity, income, and expenses prepared beforehand to guide a bookkeeper and accountant of what specific titles are to be used in describing the exchange of values in a transaction. It is important because it is designed as a way to separate expenditures, revenue, assets, and liabilities so a business can have a clear understanding and view of their overall financial health. So we have here an illustration of a chart of accounts under service concerned servicing operation. The chart of accounts shows the account titles which are arranged in this order from assets, liabilities, owner's equity, revenue, and expenses. If a transaction involves an account title which is not included in a given chart, the bookkeeper may create an account title that he or she thinks is more appropriate to use in describing the exchanges of values. Lastly, an overview about the statement of financial position or balance sheet and the statement of comprehensive income or income statement. A balance sheet or statement of financial position is a financial statement that lists the assets, liabilities, and the equity of a corporation at a certain point in time. It provides an overview of a company's financial situation and it is directly related to measurement of financial condition in the statement of financial position, while statement of comprehensive income or income statement is a financial statement that lists the revenue and expenses of the company. Also, it displays a company's profit or loss over a specific time frame. A profit and loss statement of operation statements. It is directly related to measurement of performance in the statement of comprehensive income. That's all. Thank you for watching. Bye-bye.